Good morning and welcome to the first Trust Specific presentation of our event. I'm sure we're joined by a few of you from the round table there. We're also joined by Rory Bateman from Schroder, who is just there on our panel discussion. Before I go on, there's a wee reminder that there's a Q&A panel to the right-hand side of your screen, so please submit questions through it and we'll look to address these towards the end. Rory is one of the managers of Schroder's British Opportunities Trust. It's a relatively new product launched in 2020. I think the timing of the launch was maybe no coincidence, given the challenges of 2020 and the fact that SBO is designed to have a focus on investing in fresh equity issuance. I think the prospectus alters that should be. Schroder British Options is built to have balanced exposure between private and public equity. So I think we'll hear a bit more. I'll pass this over to Rory now. Thanks.
Morning, everyone. Thank you very much for taking the time to listen to the Schroder's British Opportunities Trust story. I'm going to work on the assumption that you weren't on the previous call, so my apologies if I do repeat bits and pieces, but I think for those people who are new to the story, I really want to make sure I get the messages across. So I'm going to kick off with what I think is probably one of the most interesting and exciting investment trust launches over the last few years. And indeed, it's not only me saying this. You'll see on the next slide, we were actually winner of the 2021 most exciting company IPO. So, you know, this is designed to be an exciting opportunity for our investors to get involved in UK growth companies. When we were talking about this product through the course of last year, for those of you who don't know, we were thinking about this as probably one of the most interesting, one of the most, almost a once in a generation opportunity to get involved with UK companies, be they public or private, to exploit the growth opportunities that we see in a post-Brexit, post-COVID world. So, you know, this is about unashamedly growth. It's unashamedly about public businesses as well as private businesses, and we'll come on to the structure of the vehicle. And we want to make sure that the companies that we're investing in are making a real positive impact to society and the UK economy overall. So very much with a sustainability lens, and hopefully that resonates with a number of you on the call. So I'm going to take a bit of time to talk about the opportunities to start with, and then get into some detail about how we approach the investment with investments within the portfolio. So flipping on to the next slide, you can see that confidence in the UK is back. We are basically saying that with the post-Brexit economy motoring, and that's partly COVID related clearly, we are going to be seeing well over 5% GDP growth this year and probably next year as the economy recovers from this environment. And you can see the amount of interest there has been, particularly from international investors over recent months. The first quarter, we've seen asset allocation into UK equities back to pre-Brexit levels. So there's a real sense of entrepreneurialism from the international investor base. They can see that the UK contains some of the best companies in the world in terms of governance, but also technology, healthcare, you name it, cyclical growth. There's a whole plethora of fantastic businesses to be invested in the UK, and they are beginning to come back. Now, this is very relevant because through the Brexit period since 2016, we've seen a real reticence for international investors to get involved. We did see at the back end of 2019, when Boris got a big majority, we saw quite a spike in international interest. But as the COVID came into 2020, investors felt that the UK was managing that particularly poorly, and they pulled a load of more money out. So what we've seen since then is a real return of confidence from international investors. And as I say, that allocation in the first quarter of this year has been really strong. I think if you put that reallocation into the UK into context around what is the UK market offering, then you can begin to see why international investors are so keen. Effectively, from a valuation perspective, if you use a combination of price to earnings, dividend yield, and price to book, we're effectively trading at 30-year lows relative to the rest of the world from a UK market perspective. So very attractive opportunity relative to other markets around the world. We have seen about a 9% increase in the UK small cap market this year, but that is really just the start of the journey from a UK perspective, and that's very much what we said on the previous call. and my colleagues on that call completely agreed with that. We're beginning to see the UK strike out as being a really interesting opportunity, not just in terms of growth, but also your starting point in terms of valuation. And yes, the markets have improved recently. We obviously all know that, but 9% this year is really the tip of the iceberg. We think there's much more to go for. Let's think about some of the things that we talked about last year before we launched the trust. There is a need for equity in the UK market, and what we want to do is provide British companies with fresh equity, whether they're public or private. And that sense of going on the journey with public and private businesses by facilitating equity, providing equity, is something that the US market does brilliantly. And that's why we had a question in the previous session around, well, what is it about UK? Can we grow these businesses? Can we grow these fast-growing technology businesses in the UK, or are we doomed to failure? Well, part of it is to do with the structure of the UK market, and hopefully that will be addressed by the Lord Hill reviews. There'll be plenty more opportunity to reduce the amount of bureaucracy that we've got in the UK. But we as investors have got to get behind our UK companies, and that's really one of the key themes around the trust, the British Opportunities Trust, is to provide more fresh equity for our fantastically fastly growing businesses. And you can see here that through Q1, Q2 this year, there's been a whole number of equity raises so far this year. In fact, obviously over the last 12 months, we've seen a massive escalation in fresh equity, and we love that. We think that's great. Let's pick our companies wisely. We're not interested in companies that are distressed in terms of that equity raise process. We're interested in companies that are raising fresh equity in order to grow their business, and we've already participated in a number of those in the trust that we'll talk about in a bit as we go forward. I think that we should also flag that it's not just us that are seeing the opportunities in this market. This year has seen 13 takeouts by private equity of UK listed companies, and that's the highest level since 2006. And that 13 figure compares to just 2 in 2019. So you can see that not only us as investors on the public side, but the whole private equity space are really seeing a fantastic opportunity with regards to UK small and mid-cap companies, and indeed large cap companies. And that's why we've seen such a massive escalation in private equity bidding, as we've seen very recently. The other thing, of course, is the market is very hot. We're seeing a number of IPOs, as you can see from the right-hand side of this chart. The number of IPOs has picked up dramatically over the last 12 months or so. And indeed, I kid you not, we are currently looking at around 10 IPOs in order to invest in for this trust. We've already invested in 2 or 3. They've done very well for us. You have to be selective. So out of that 10 IPOs that we're looking at right now, we're probably only going to go for 1 or 2. But nonetheless, these are fantastic growth businesses, and we will happily provide them with fresh capital in order for them to grow their business. So if we think about a bit more about the structure of the fund, as it clearly says, this is not just another small and mid-cap investment trust. This is highly differentiated. This concept of public-private, we're going for 50-50 in terms of the split within the trust. We're not there yet. We've got about 25% in the private side after 6 months, so we're on track. At the time of the IPO, we said it's going to take 6 months to get to 25%. When we're there, we would expect to fill up the other 25% in private equity within the next 6 to 12 months. So again, on track for what we said. On the public side, naturally, that hasn't been a problem. We are fully invested. We've got over 50% of the fund in public equity. And so the fund itself is now well over 80% invested if you include some futures. And we will look to sell down some of those futures and sell down some of the larger equity holdings and some of the companies that have done very well in order to fund the private equity deals as they come through. So we haven't suffered from cash drag. The NAV has increased well over 10% so far this year. Obviously, markets have helped, but our stock selection has been very strong, and the NAV is in very good shape despite only being launched for 6 months. You can see that a couple of comments on this slide. The strong ESG engagement. We have written to a number of companies on the public side, and on the private side, there's obviously a regular interaction with the senior management. We look to engage with our businesses to try to ensure that they are taking all of their sustainability requirements seriously, and we do that directly with the company. We're writing letters, we're trying to get them engaged with us, and they love that engagement. They want to go on this journey with us, And so that's something we're pushing on an open door with regards to sustainability and the adoption of the SDGs, as it says in the third comment on the page. I've mentioned supporting high quality growth. We'll come on to it in a second. What do we mean by growth? And obviously, in order to make this fund very attractive, we wanted to democratize private assets, if you like, and we wanted to ensure that our investors are able to achieve exposure to private equity at a very low fee. And the fees on this trust are very appealing. We're not charging a performance fee, obviously, on the public side. There is a performance fee, albeit very moderate, with a 10% hurdle on the private side. And so we can talk about that in the Q&A perhaps. The other thing is we were challenged when we were launching the fund, what happens if the fund has a persistent discount? Now, clearly we don't expect it to have a persistent discount, but in order for us to achieve a pull to par, we've adopted a 7-year fixed life of the vehicle. Why 7 years? Well, because the average holding, or rather the life cycle of a private equity position is typically 7 years. There will be some that go beyond that, but most funds, private equity companies are bought and sold within the 7-year life. And so that gives us a natural exit after that 7 year. We do, however, fully expect to be trading at a premium. We do expect to have this to become an evergreen vehicle, and we hope to obviously roll that vehicle on for another 7 years, subject to the performance of the trust after that period. Early signs are very encouraging. So let me flip forward to the next slide. So I mentioned growth. We are both on the public side and the private side aiming to achieve real high growth businesses in this trust. So what do we mean by that? Businesses that are transcending their growth trajectory as they inject more capital into their company. And so you can see businesses that are already growing strongly. They are effectively taking market share through the pandemic and beyond. And these are high growth businesses, double-digit growth businesses that are effectively beneficiaries, you could argue, of the COVID, and they are taking market share. And we've got a number of those that we can talk about. And this applies both on the public side and the private side. Then we look at mispriced growth. There will be some really fantastic structural growth businesses that have been impacted by the pandemic. There is, of course, no question about that. And what we've done is identify a number of those businesses, and we've thought to ourselves, well, let's think about businesses in the medium term, think about their growth trajectories as we emerge from the pandemic, not companies that are distressed in terms of balance sheet. We've got one or two where you could argue there are balance sheet issues and they will require fresh equity in order to grow out of the pandemic, but they are very minimal. What we're talking about here is companies that have maybe hit a bump in the road through the pandemic, and that was particularly the case within the RNI space in the second and third quarter last year. Those businesses we invested in at the IPO were under a cloud. They have actually come through really strongly in the first quarter this year. We'll talk about Volution in a minute, which is one of those examples. So hopefully that clearly explains what we mean by growth, and we'll come on to some individual stock examples as we go through the presentation. Let's think about the structure of the team. Basically, you've got myself. I am backed up by an incredibly strong UK investment team at Schroder's, as you might expect. We've got 19 dedicated public equity professionals. I've taken a slightly different approach to this trust. There is very low commonality between this trust and anything else that we own within Schroder's in the small cap space. That is deliberate. I've mentioned the focus on growth. I've mentioned the focus on fresh equity, and the 6-person team that I've got with me working on this product. We're really focused on differentiated companies. Quite often we've known these companies for a number of years. Quite often we haven't. We've obviously mentioned a number of IPOs that we're participating in, and fresh equity opportunities. So the idea is for me to get my team to focus on businesses that are not legacy Schroder's positions, but to go out there and explore, the thousands of companies that the UK currently has within the UK mid cap, small cap, and on the AIM market. And at the moment on the public side, about half the portfolio holdings are mid cap and about half on the small cap and AIM listed markets. So it's a very diverse portfolio across those 3 segments of the smaller mid cap area of the market. On the private side, Tim Creed, he's our head of private equity investments in Schroder Advec, now called Schroder's Capital. Tim has 20, 30 years experience within the private equity space. He's backed up, as you can see here, by a huge dedicated team of specialist private equity expertise. And his role is frankly to find the best opportunities within the UK market. He's delivered with his team very high annualized returns over the past 20 years. And it's been, we can talk about that in more detail on a separate occasion, or indeed through the Q&A as we go through the presentation. We take governance very seriously. We've got an oversight committee which basically consists of senior investors around the firm and senior management to ensure that we are appropriately managing the mix between public and private. But Tim and I work very closely together with our teams. We sit down regularly, talk about individual ideas, and that benefit of sitting down, talking about both public and private ideas, whatever the sector, gives us the opportunity to maximize the opportunity within that sector. We don't care whether it's public or private. We want to get the best opportunities within the fund, and that's really why, by having this collaboration between the teams, ensures that we maximize the opportunity irrespective of the sector. Naturally, with any investment trust, we have an independent board. It's a very diverse board, and they've been really constructive in helping us develop the product so far. Okay, so that gives you a flavor of what we think the proposition was, and it gives you a flavor for the team and the structure of the fund. But let me talk a little bit more detail about the portfolio overall. And as we go forward, you can see on slide 10 the progress since the launch. And what are we talking about here? Well, I've mentioned briefly, as we launched the IPO, we wanted to get the capital put to work quickly because we were very confident that the market was in a good space. Obviously, we had the launch of the vaccines at that particular time, so we wanted to get our proceeds invested very quickly. So we out of the gate, we got invested on the 1st of December as quickly as we could. We invested pretty much 50% of the fund into public equity straight away. We bought a little bit of futures to get more exposure, and then Tim started to come through with the private equity deals. Obviously, they take some time, but within the first 3 months, we had 3 deals and some really fantastic companies that I'll refer to in a second. And then in the second 3 months, in the first quarter of this year, we put a lot more capital to work, and now we're up to 6 private equity deals alongside the 28 public equity companies that we own. So we are, as I mentioned, well over 80% invested, and the NAV of the trust, as you can see from Bloomberg, is now trading at 109. So that's after costs and expenses, we've delivered well over 10% in terms of the return profile within that 6-month period. Very happy to say that has been exactly on track. We've slightly exceeded our expectations in terms of the return profile. We are targeting a minimum 10% per annum return profile for the fund over the 7-year period, and we're well on track to achieve that this year. But of course, there are no guarantees, and we do need to get those private equity deals into the portfolio, which are really exciting and propelling the growth of the fund as well as we go forward. And I'll come back to a specific example about what we've done on the private side in a second. I mentioned the third box here. We've been very deliberately investing money into fresh equity into public companies. So we've invested already in 6 IPOs. In fact, it's more than that, but we've done 6 IPOs into primary issues, sorry, a couple of IPOs and fresh equity issuance from companies that we had in the portfolio through rights issues, through placings, and so on. We've also done a secondary as well. So there is this concept of providing fresh equity to the companies that we own in the trust is very real. We're living and breathing that. And finally, I've talked about the ESG and the SDG mapping process, and that works across both the public and the private space. Very happy to take some questions on that. So if we think about going forward, I can skip this slide, apologies. Right, so if, in fact, let me go back to this slide. If I can think about, sorry, apologies everyone, my slide deck has just been here we go. Okay, so just a little bit more detail about the deployment. I mentioned just a minute ago, we on the right-hand side, you can see here 28 public holdings. The primary equity participation, Infinity, Ideagen, Genuit, SSP, Tiny Build, and Trustpilot were the 2 IPOs. The secondary was Keyword. I think what's really fascinating, and a lot of our investors are really super keen in the private component of the portfolio. Obviously, the information is much more limited, but you can see here 6 private equity investments to date, and broadly speaking, we split these out into buyout and growth, and growth, and Tim has separated these 3 areas into at least 6 companies into the 3 separate areas. As you can see here, growth, Graphcore and Rapid. Now, obviously, Graphcore is well known in the private equity space, particularly, and there are 1 or 2 other investment trusts that know Graphcore very well. This is the microprocessors company, specifically around artificial intelligence. Fantastic business, and this is a company that's probably going to IPO at some point. So having the benefit of the private, the public equity team sitting with the private equity teams means that when Graphcore came in to see us for capital raising around the private side of the business, we were able to already at that point put our public equity team in with that meeting. The management thought that was brilliant. It gives the company an exposure to public investors. It enables the management to build up a rapport with the public investors, so that when that company comes to market, not only does Graphcore know that Schroders are significant backers in the private space, but we're also early door investors into the public space. So we will get exposure to many of the fantastic deals that are coming through the IPO corridor, and that is something where joining the public and private together, that's a real value add, and frankly a unique proposition for this particular trust. So part of the proposition is for us on the public side to get involved with these private companies that are coming to market at some point in the future, get involved, get to know the management, cornerstone invest some of those IPO through the IPO process. So really fantastic opportunity. Rapid is probably the most fantastic growth company that everyone hasn't heard of in the UK. It's the world's largest local payments network. It's a B2B, typically B2B payments network. It invests in, it manages their businesses in several countries of the world, and it is in fact, as I say, the largest payments network in the world. So everyone's heard of Strike in the US, and we've got lots and lots of high expectations for that company as we go forward. Very exciting. On the growth buyout stage, Sera is it's the leading technology company, home care provider. So this is a very fragmented market in the UK, where you get typically individual local authorities, sort of mum and pop businesses going to help out individuals in their home. It's a very underserved market. There's very little technology involved. What Sera are doing is injecting technology into this business. You may ask how they're doing that. Well, it's all a function of timing. It's a very inefficient market in terms of the process involved with people delivering, whether it's a helping hand to the individuals in their homes, or whether it's food, etc. By injecting technology in this, it can massively improve the efficiency of this type of business. And it sounds relatively mainstream, but I can tell you that they are making huge strides, particularly around the technology developments around home care. Easy Park is it's a global mobile phone parking operator. Really interesting company. They have effectively apps. And so when you go and pay for your parking, as you go to this into the town centre or wherever, the chances are it will be an Easy Park franchise. They own a number of the UK franchises and indeed have operations around the world. So the fantastic thing about this business is, again, the technology. We're getting to a stage now where the problem around parking in town centres is so acute that the people looking for parking spaces contributes around 70% of the pollution within any individual town at any point in time. So if you get an app that tells you where there is a free parking space, you actually use your app to find that parking space, and you can cut down on the amount of pollution that's going on within any town centre. So this is the type of the type of technology that Easy Park are using, and it's a phenomenal business, really exciting growth potential for that one. On the buyout side, Learning Curve, this is education and training for UK professionals. They have a really strong position in that market. I hope that what we've done on the public side is use one of our companies that we've invested on the public side. We've come together and collaborated on the cross-fertilization of the knowledge around the education and training sector in the UK. And that's been really beneficial for us to get to know a lot more about what's going on the private side so that we can make an informed judgment about our position on the public side. WaterLogic is, again, there's a real strong sustainability theme to this. You may recall that you may even have them in your offices, whereby you've got the big plastic water coolers. These are most definitely a thing of the past. WaterLogic is, they effectively put water dispensers into buildings. They are a fantastic business where the water is filtered. WaterLogic installs the dispensers into your office, or whether it's local authorities, whether it's hospitals, you name it, WaterLogic are there. They're taking huge market share, and again, there is a very strong sustainability story around the particular business. So, really exciting 6 companies. I can tell you now that the pipeline as we go forward is really fantastic. So you can expect us to put another at least another 6 exciting private equity deals as we go forward. I just want to make one more comment before I get on to the public side, and I realise time is running out. One of these companies has already had another funding round. That funding round came through at twice the valuation that we were able to get the initial allocation into the fund. So the valuation of one of these businesses has already doubled within the portfolio, and you will have seen that on Bloomberg. So whilst this is a relatively rare occurrence for this to happen so quickly, we funded the deal back in the first 3 months of the fund being open, and that valuation has already doubled. So it just gives you we had I think it's 2.5–3% uplift on the NAV. So that gives you an indication of the types of businesses that we're investing in on the private side. Very exciting, and we would fully anticipate that we get a number of these fantastic businesses going forward into the portfolio. So quickly on the public side, you can see here that, as I mentioned before, cost of primary participation, secondaries, material reduction, we made a couple of this. On the right side, what about there?
Rory, can I just stop you a second? We are experiencing a bit of sound distortion at the moment. I don't know if you want to just pause for a second. It's becoming a bit inaudible at the moment. So we just apologies, ladies and gentlemen. Let's just sort that out so that we can hear you. Just bear with us for 2 seconds. Apologies.
Hello everyone, I hope you can hear me. I'll carry on, Callum, unless I hear otherwise. So look, as you can see from the public equity slide here, we've invested in several primaries, secondaries, we've got a material reduction on Blue Prism, and we've made a couple of exits. I was just saying before we were interrupted, Callison was a company that we actually got to take out within the first month of the fund launching, which was very pleasant. We made a quick 30% return on that one as the company was bought out by the majority private equity owners. And we've already talked about the appetite for private equity taking out public companies in the UK space. So really interesting. I'm very pleased to see that and hopefully see more of that. Look, time is very, very limited, so I will spend a couple of minutes on some holdings that we've got. Solution, a phenomenal business. This is a company that we put into the portfolio from day one. Obviously, in terms of ventilation and the whole renewable energy space, this is a really interesting opportunity where you can basically buy into a company on a very low valuation at the time. It's obviously gone up a lot. The company's done about something like a 90% return profile since we launched the fund. This is a business that is taking full advantage of the increased regulation around residential new build requirements around insulation and home ventilation. So there will come a day, we've also got Genuit in the portfolio. There will come a day, obviously, when we'll have no carbon fuel access to homes at all. And so by having effective ventilation, heat pumps, renewable sources of energy, and Volution and Genuit are going to be clear beneficiaries of that. And we think that these companies, yes, the valuation discounts have closed, but actually, if you think about these companies relative to the European peer group, they're actually trading on very, very attractive multiples. They're right at the bottom end of the range. So yes, they've gone up a fair bit, but we think, as I said before, we're at the start of a journey here, and we think this company can grow their earnings base well beyond current expectations. And so it will continue to be a theme within the portfolio, and we think Volution is in a great place to exploit the themes that we talked about. TinyBuild is a really successful IPO. This is a business that we bought at the IPO, and the company has increased 50% or so. In fact, it went up 70%, where we took a little bit of profit, and is now up about 50%. So it's clearly a video games publisher and developer. They've got a big back book. They generate something like 70% of their revenues from the back book, and Hello Neighbor is the big brand. So they've got this existing cash flow, which will facilitate the growth of the new products going forward. And they do derivatives from the Hello Neighbor brand, Secret Neighbor, etc. I'm not an expert, but you should maybe check that one out on one of the apps. Obviously, from a cost perspective, they source a lot of their developers from Eastern Europe, so they have a far better profitability than the peer group. And they're looking to expand internationally, utilizing that Eastern European footprint of developers. So again, a very exciting company. In the spirit of full transparency, we did invest in Trayline. We actually felt this was a business that has fantastic opportunities in Europe. We were obviously very aware of the regulatory concerns. The concept of a Tory government pushing through a nationalisation of the national rail industry was, however, a significant surprise. And our position in Trainline is now under review. It is going to take a long time for the government to get this competing service up and running. The chances are they'll offer Trainline a concession. But as I say, I think we've got plenty of time. It's well shorted, and we think that there may be a bit of value in Trainline right now. But as I say, it is under review with all the activity that's happened recently. So I'm going to stop there because clearly time is running out. Callum, apologies for overrunning, but obviously we had the communication errors. I'm guessing that people are well familiar now with the opportunity itself from a UK perspective. The public-private differentiating proposition of the FBO fund is hopefully now clear. The upside in terms of UK businesses, we think is phenomenal. I do believe this is the start of a journey, a once-in-a-generation opportunity, as we called it, and hopefully we can now go into some Q&A and answer any questions.
Yeah, we'll try and get through a few of these. We had a few come in, but obviously we had the wee delay with the sound problem there, but please keep them coming in anyway. Couple in about the Schroder UK Public-Private Trust, and just trying to understand a little bit how this is different from that, why this is not just another iteration of the same product. If you could sort of maybe talk through that really briefly.
Yeah, these are very different propositions. I mean, as anyone who's been familiar with SUPP will witness, that the company has been very, very heavily dependent on the private side, early stage venture businesses. What I failed to mention so far about SBO is the fact that all of these companies that we're investing in are very profitable. These are very well established businesses. I've mentioned that a couple of them are already world leaders in the fields that they're operating. So you won't find any venture within the SBO. Within SUPP, it's much more about venture and growth. I've mentioned that SBO is about growth and buyout. So very different ends of the private equity spectrum. There will also be an unashamedly significant bias towards growth within SBO, as I've mentioned, and there will be no overlap in terms of the holdings in either the public or the private.
That's great, thanks. I think a question in here about the fixed life nature and how that prevents the discount potentially going out too wide. And the question is really about whether or not you might be subject to fire sale prices and forcible sales at the end, and just how you're going to manage liquidity around that. I mean, that's obviously a way off in the future, but more generally, how you're going to manage liquidity, especially in the private businesses, and the trust would be useful, I think.
Yeah, and that's a very good question. I mean, essentially, the reason, as I mentioned, the reason why we put a 7-year life on this is to ensure that we are able to manage the private equity exposure through the life of the vehicle. And what you might see is Tim and myself talking to our shareholders, looking at where we stand on year 3, year 4, thinking about, well, how is it going? Are we trading at a premium? Is there significant appetite for this 50-50 split within the public-private? And so we will be engaging with companies all the way through the life of the vehicle, shareholders, all the way through the life of the vehicle to ensure that once we get to year 5 or 6, the portfolio is in a good shape, subject to where we need to be. If there is significant appetite and the shares are doing well, we will probably reinvest some of the proceeds from the private sales back into private. And that's sincerely what we hope to do. If there is a problem and we think we are trading a discount and we need to conclude the vehicle after 7 years, then you might see an escalation in the quantity of public positions within the portfolio as we approach year 6 and 7. But Tim is very confident that we can manage the private equity exposure. He's been doing this a long time. We will be able to manage the private exits towards the 7-year period without a problem. But as I say repeatedly, we sincerely hope and expect that this vehicle will get a renewal at 7 years, and we hope that our shareholders will go on that journey with us.
Great, thanks. Obviously, the trust operating in a 50 million to 2 billion sort of range. Just how do you expect to skew that between the two? Is it really just going to be based on the opportunity set, and do you think there may be any difference between the public and the private allocations on that range, market cap wise?
We're totally flexible around the market cap within public and private, and there will be no skew. This is about each individual opportunity. As I said before, the beauty of having exposure and expertise in both public and private means that we will trade off, and we are trading off companies in the public and private space to ensure that we get the best opportunity. So, I mean, obviously, private equity deals take a much longer time to get into the portfolio and to get that knowledge base built up, whereas we have far more flexibility on the public side. But to have that ability to compare and contrast across public and private is really a highly differentiating feature of the fund.
Okay, that's great. Obviously, this is a growth product and it's targeting total returns. Do you anticipate there being any sort of dividend payout from the trust in the future, or if you're receiving dividends from the end of the line, is that a sign they're not reinvesting enough?
I mentioned that the portfolio right now has about half of the portfolio on the public side is in the mid 250, and some of those companies are paying dividends. So that's not typical. We're not targeting payouts from the cash flow, but part of the reason why we've got some mid 250 companies in the portfolio is for liquidity purposes. I wanted to ensure that we remain very liquid on the public side. We run the analysis, and with the exception of one company, in fact, we could pretty much liquidate the portfolio within 4 days. That's with only using 20-30% of volume. So I would ensure, and I will ensure going forward, that the liquidity of the fund is maintained. Clearly, we don't want to get into a position where we're running public equity where there's no liquidity. That would undermine some of the features around the product, and we want to ensure liquidity is retained. But on the cash flow dividend side, we're not targeting dividends. We expect our companies to be reinvesting.
That's great, thanks. I think we've got time for just one more quickly, maybe. So I think you already alluded to it, to be honest, when you talked about the second funding round from one of your private companies and you saw the valuation double. How efficient do you find the private market to be at valuing the opportunities relative to the public market right now? Well,
I can say this Tim's not on the line. I have been blown away by the opportunity set with on the private side. The exposure that the private equity team gets to businesses in terms of either venture, growth, or buyout, it's phenomenal. And the valuations that they are able to enter these companies at is also extremely attractive. They work with the companies quite often from day one. Tim and his team have been involved in a number of very, very high-profile, multi-billion-dollar companies from day one, and they participated in some companies that have grown 30-fold. And it's very difficult to achieve that type of return profile in the public market, as we all know. Occasionally, we'll get some real winners like Volution and Tiny Build that I've mentioned, but it's very difficult to get that level of appreciation on the private side. What we're trying to do here is obviously combine the best of public and private, but I can tell you that it is an amazing market, and the opportunity set that the private team get within Schroder Advec is really phenomenal.
That's great, thanks. I think we're out of time, unfortunately. We need to get set up ready for our next conference, but just want to say thanks again for your presentation. Informative for me as well. And thanks to everyone for listening. Thank you.
Great. Many thanks for taking the time.